when you talk about the yield curve, which has been so massively inverted, and the uninverting of the yield curve is typically when we see this recession. But in fact, if you go back over the last 50 years, I don't think there's been a time ever where the yield curve was inverted, especially the way that it has been over the last year or two, that hadn't been the precursor to a recession. The difference is, and to your point, that most of the time we would see that it would be the Fed coming in and lowering the front end of the bond market to stimulate growth. Well, we'll drop short-term interest rates, and hopefully people will take loans and speculate, et cetera. This time, it's not been that. In fact, the Fed has been raising the front end of the short end of the curve, and what we have been seeing is the back end rising, not at the behest of the Fed, but at the market directing yields higher. You have a situation where, as with the banks as an example, as depositors are coming in to redeem their deposits, as people in bank accounts say, I want out of the bank. These banks are undercapitalized. They have to sell their 10-year treasuries, which in and of itself lifts yields. But the bottom line is you have the banks in trouble. You have the governments, China, Japan, Saudi Arabia, they're all dumping 10-year treasuries. And as they're selling their treasuries, which have been the worst performing asset period over the last several years. In fact, go back to 2020, this will be the worst bond market disaster in history in terms of a bear market. And so as these sovereign nations and as these banks unload their 10-year treasuries and longer maturities, the back end is rising on its own. And so you have a situation that's doubly troubling as far as I'm concerned. A bond market that I think the Fed is beginning to realize that the market is much bigger, if you will, than the central bank. The market should control the rates, not the Fed. The market should be controlled by, or the rates should be controlled by the natural forces of the market, not by the Federal Reserve. In a historical context, treasuries and government debt, it's a relatively new ideology historically that government debt represents savings. I think they're beginning to realize that that may not be the best pathway, and I think we're seeing a move back to gold as being the preeminent form of savings. And my justification for saying that, it's not that I'm a gold dealer, it's the fact that you have the worst 10-year treasury performance in history last year, coupled with the greatest amount of gold acquisition in history by the central banks. Do you think there's any coincidence in this, that as the central banks are buying gold, they're shedding treasuries? And I don't. And I think that this is a trend that will continue. And we are a country that has signaled more or less that we will choose inflation over austerity. We will choose to not raise yields high enough to break everything apart, and we will inflate our way out of it. But I have said for a very long time that the market has other plans for the treasury market. It will be the dumping of dollars globally that will push rates markedly higher. The bond market will be something that will be forsaken for quite some time, the illusion of safety in a treasury market that has, in my opinion, lost trust, has lost faith in a country that is 150 trillion in debt. Forget about the 32 trillion. How about the Medicare and the Medicaid, the Social Security, the government military pensions that are 130 trillion? We are indebted. We're borrowing money just to pay the interest on the money we borrowed last. We're insolvent. We're 130% debt to GDP. And you know what, Patrick? Anytime a country in history has crossed that Rubicon, it's never come back without defaulting, whether it be outright default or hyperinflation, which is a form of default. So this is stage one of what I believe is a bond market, debt market, liquidity crisis meltdown. And as it gets worse, which I believe it will ultimately, I think you will find gold and silver being looked at by the world differently than it has in a very long time. And they say the more things change, the more they stay the same, or history doesn't completely repeat itself, but it rhymes very often. And, for most of human history, gold and silver have been considered wealth. Very, very sophisticated investors, the central banks, who not only have bought more than at any time in history over the last 18 months, their numbers this year they bought over 800 tons this year. They're up 18 or 20% year over year. They're continuing this trend. So yeah, I think this is a trend that will continue, and a bond market that anyone who's holding long-term treasuries, I think, needs to really take a hard look at their portfolio. I think that this is a time when people need to look at precious metals not as an investment, but as wealth. And you throw on top of it the fact that the BIS reclassified gold as the only other tier one. Do you think there's any coincidence that the most well-funded and, more importantly, well-informed traders on the planet, the central banks, have bought more gold than at any time ever? So far this year, central banks have bought about 25% of worldwide gold production. Central banks have bought 800 tons in the first 9 months of the year, up 14% year on year, according to the World Gold Council. Well, they bought more gold than ever over the last 18 months, and now they're even going higher. So how does it happen? How does the Great Reset happen? It happens because the world dumps the dollar as being the sole settlement currency for oil. And it's not going to happen immediately until it does happen immediately. I call it logarithmic decay. Little by little by little by little by little by little, then bang all at once, going over the waterfall. The pitch starts to change little by little. But look around us. The little by little are all of these countries striking deals outside the dollar. All of them, all the BRICS nations, all of these countries are moving away from the dollar little by little by little. What is the event that makes it happen all at once? I'll tell you one thing. If you are not prepared for that, you're done. If you're fully invested in traditional assets, you're done. Now it gets to a point where you have a situation where there's the faith and the credit side of things too. You get the full faith and credit of the United States, not just the Petro Reserve status. And the 2022 balance sheet came out and said we're 160 trillion in debt, or 155 trillion in debt. Medicare, Medicaid, Social Security, government military pensions, on top of a $33 trillion debt. We raised the debt ceiling a few months ago, and we've already added 2 trillion to it. It took us over 210 years to print the first 2 trillion. We did it in a few months. It's accelerating at a massive, rapid pace. And well, this is a very big problem. So when we talk about debt burden or the credit, we have crossed the 130 debt to GDP ratio. We're insolvent. We're broke. So the petrodollar, throw it out the window. The credit, throw it out the window. How about the faith? Now you're looking at us from Singapore. You are originally from the United States. But you have maybe a different perspective on this now because you see it through the eyes of a media that is not Western biased.